All right, the news from Libya today was a distraction for many from the state of Europeans' debt crisis. My next guest, though, he was paying attention. Domenico Lombardi is a senior scholar at the Brookings Institution. He's a former board member at the World Bank and the International Monetary Fund. Domenico Lombardi, good to have you with us on Bloomberg. Explain a little bit, if you can, about what has changed in Europe or what has not changed. You have Angela Merkel coming out over the weekend and saying, they don't want Euro bonds. They think that it would really prove a contradiction to the German constitution. What is she talking about?
Well, nothing has changed, to be honest, except that the problem is still there. We have a monetary union that is severely under attack. There is a number of countries that share monetary sovereignty, but there is no fiscal union. And this is really, in a nutshell, what is really, at the heart of the problem. Now, this issue of Eurobonds is certainly something worth considering, but it should not be overstated in the sense that the Eurobond is an instrument in itself, is not an objective. The Eurobond presupposes, requires some degree of pooling of fiscal sovereignty. If there is no pooling of fiscal sovereignty, as it is right now, nor there is any appetite for that, clearly, there is no room for Eurobonds. But what is also important is that, of course, Eurobonds would, help to stabilize the debt crisis if there were, some agreement towards pooling of fiscal sovereignty. But what is also key is how to enhance the growth potential of the euro area. There are some countries, Italy in particular, whose growth has really been lagging behind, growing at rates of 0.3%, 0.4% over the latest few years, and it is still projected to grow at these low rates. Under this scenario, there is no way that a country like Italy can sustain a burden of 120% of debt compared to its GDP.
Well, Domenico Lombardi, what about the possibility of a country like Italy temporarily leaving the euro? Would that help to solve or alleviate some of its problems? In other words, not doing it because it's going into a default, but do it because it would help its export-based industries.
I don't think it is feasible right now to consider the exit of a country like Italy from the euro area, most of all because there is such a high degree of interconnectedness among euro area countries that it is not imaginable nor feasible at the present time to imagine a country, a systemically important economy of the euro area like Italy, to exit the euro area without consequences. But what is important now is for Italy to make sure that they undertake the right measures, they introduce the right measures to stabilize markets. The government a few days ago proposed a number of measures that unfortunately don't go in the right direction. Such measures are of a one-off measure. They will likely increase fiscal pressure, which is already high in a country like Italy. And there is no guarantee that the objective of a balanced budget to be achieved in 2013 will be sustained over time. And moreover, there is no room for growth-enhancing measures, which is, as I said, really key in a country whose economy has been growing at dismally low rates. And therefore, my sense is that we are really wasting precious time, especially for a country like Italy, where if you don't enact preventive measures, it may be too late later on to intervene either through the IMF or the EFSF, that is the European Rescue Fund, because simply they do not have enough resources to bail Italy out.
All right, we're going to leave it there. I want to thank you very much, Domenico Lombardi, joining us from the Brookings Institution, sharing his thoughts about the continuing European debt crisis.